Hi, I'm Chris Rizzolo, and I'm a partner at Evershed Sutherland. And with me today is Susan Seabrook, and she's also a partner at Evershed Sutherland. We're here to talk to you about the changes in the 2017 Tax Act with regard to Subchapter L. Congress made a number of changes to Subchapter L, and we're going to hit the high points here in this video. Susan, you want to start off with the changes to life insurance reserves?
Sure. The calculation of life insurance reserves has been changed. It is now the greater of the net surrender value or 92.81% of CRVM or CARVM, depending on the contract. There's special rules for variable annuities, and the reserve is determined using the methodology and factors that are used at the time the reserve is computed as opposed to at the time the contract was issued. There's also a repeal of 807F, which was a special rule applying to changes in basis of reserves, and now changes in reserves are treated along the same lines as any other change in method of accounting, and so you have a 481 adjustment as opposed to the 807F adjustment.
So do life insurance companies have to go in and ask for a change?
No, actually the statutory language does solve that. It's treated as a taxpayer-initiated change in method for which the taxpayer has received consent. So that's not an issue. But there is an issue in terms of, now that it is a change in method of accounting, it is subject to the whole clear reflection of income standards, so it leaves it a little bit more vulnerable in terms of IRS-initiated changes to your method.
For property and casualty companies, the change to the reserve increases the amount of their discount. So there's a change to the interest rate so it's now based on the corporate bond yield curve, and there's an extension on long-tail business to the period for the loss payment patterns and some changes to the payment assumptions so that you end up with a longer, flatter curve that could last up to 24 years. There's also a repeal of the provision that allowed taxpayers to use their own payment patterns. So now everybody's going to have to use the IRS's tables. Mm-hmm. There's a transition rule so that on the change from the old rules to the new rules, you'll have to take the changes into account over 8 years.
So there's no fresh start?
There's no fresh start.
Let's talk about DAC a little bit. So insurance companies are required to capitalize and amortize a portion of their policy acquisition expenses on specified contracts. Essentially, the capitalized amounts are referred to as DAC, and the DAC rates have increased under the Tax Act. They basically, by type of contracts, so annuity, group life, and other specified contracts. But I think the more important thing, or the thing that we'll consider more as time goes forward, is that the amortization period has changed. So rather than having a 10-year amortization period, it's now lined up with all other Section 197 assets, and it's a 15-year amortization period.
So let's turn to proration.
Sure. So proration is necessary to take into account tax-exempt amounts. And so in the life insurance industry, we had a rather complicated formula, complicated sometimes, that's been switched now to a very simple formula, which is 70% company share and 30% policyholder share.
And in the property and casualty area, it went the other way. So there was a set 15% rate for proration, and now it's a formula. So the proration percentage equals 5.25% divided by the current maximum corporate rate. And with the 21% corporate rate right now, it's a 25% proration rate.
Turning to NOLs for a minute, in the life insurance industry, the new act repealed the NOL rules. And so now life insurance companies are on the same NOL rules as all other corporate enterprises, and the NOL is generally limited to 80% of their taxable income, and there's no more carryback, and it's carried forward indefinitely.
Property casualty companies are not subject to the new rules. They actually get to stay on the old rules, so they get the full amount of the NOLs. They get a 2-year carryback, and they get a 20-year carry forward.
And I understand they no longer have to worry about the AMT.
Yeah, so under AMT, they used to have their NOLs cut back. Now that they don't have AMT because it's been repealed, they'll get the full amount of their NOLs.
Chris and I really only hit on the high points, the specific Subchapter L changes. Of course, all of the other corporate changes apply to insurance companies. So if you have any questions, please contact Chris or me, or go to our website at eversheds-sutherland.com and consult more of our bottom line videos. Thanks very much.